So I was sitting there looking at my spreadsheets, which, let's be honest, is how I spend 90% of my Friday nights because I'm a blast at parties. And I realized something that actually made me put down my 20-cent iced coffee. We've been told for decades that term life insurance is the gold standard. It's cheap, it's simple, and it's what every financial guru on the internet screams about. But what if the most popular insurance strategy is actually a wealth killer hiding in plain sight? Honestly, the math is brutal. We are talking about a system where you are essentially betting against yourself, and the house, the big insurance corporations, has rigged the game so they win 99% of the time. Anyway, before we dive into the numbers that your insurance agent probably forgot to mention, do me a quick favor and hit the like button for the YouTube algorithm. It helps the channel out tremendously, and unlike a term policy, it actually provides a guaranteed return on investment. Here's the thing about the psychology of low monthly premiums. It's the ultimate peace of mind trap. You're 30 years old, you've got a new house, maybe a kid on the way, and an agent tells you that for the price of a couple of avocado toasts, roughly $45 a month in today's 2026 money, you can have $1 million of coverage. It feels like a steal, right? But that low entry cost creates this false sense of permanent security. You feel protected, so you stop looking at other options. But by the time we hit 2026, inflation has been eating away at the real-world value of that fixed death benefit. $1 million just doesn't buy what it used to when rent has climbed by 35% in just a few years. You're paying for a safety net that's effectively shrinking every single month, while you're busy thinking you've checked that box on your adulting list. It's like buying an umbrella that gets smaller every time it starts raining. Eventually, you're just standing there holding a toothpick while getting soaked. Now, let's talk about the 99% success rate. And no, that's not your success rate. That's the insurance company's success rate. Industry data shows that the vast majority of term policies, about 98.5% to 99%, expire without ever paying out a single cent. Think about that. You are paying a premium for 30 years, and the insurance company is using precise actuarial data to bet that you will outlive that term. They know exactly when you're likely to kick the bucket, and they make sure your policy ends 5 minutes before that happens. It's a bit dark, honestly, but they've turned your life expectancy into a profit margin. You spend 30 years contributing to their bottom line, and the moment you actually become high risk, the moment you might actually need the help, the policy vanishes. It's like paying for a gym membership for 30 years and then getting banned the second you actually try to lift a weight. It's emotionally draining to realize you've essentially handed over $20,000 or $30,000 over your lifetime for absolutely nothing in return. And then comes the cliff. This is where it gets really ugly. Let's say you hit 60 or 65. Your term ends, but, surprise, you realize you still need coverage. Maybe the mortgage isn't paid off, or the low-risk index funds didn't perform quite like the 2024 brochures promised. When you go to renew, those premiums don't just go up a little bit, they spike by 800% or more. I've seen cases where a $50 monthly payment jumps to $1,200 overnight. And that's if you're healthy. If you've picked up any medical issues over the last 3 decades, which, let's face it, most of us do, securing new private coverage becomes nearly impossible. You end up in this coverage gap where you are at the highest risk of your life, but you've been priced out of the market entirely. It's the ultimate gotcha moment in personal finance. But the real kicker, or the thing that really keeps me up at night, is the hidden opportunity cost. If you take that $50 or $100 a month and put it into a term policy, at the end of 30 years, your account balance is exactly zero. you have zero equity, zero cash value, and zero liquidity. Contrast that with the 2026 market, where high-yield digital assets or even a basic S&P 500 index fund could have turned those premiums into a significant nest egg. By choosing term, you're forfeiting the ability to borrow against your own protection. If an emergency hits, you can't touch that insurance money. It's locked away in a corporate vault. You're basically giving the insurance company an interest-free loan for 30 years while they invest your premiums and keep all the gains for themselves. It's honestly kind of brilliant on their part, but it's a disaster for your net worth. So what should you actually do instead of blindly following the buy term and invest the difference mantra that hasn't been updated since the 90s? First, you need to look into laddering your policies. This means having multiple smaller policies that expire at different stages of your life, like one for 10 years to cover the mortgage and one for 30 for the kids. So you aren't paying for excess coverage you don't need later on. Also, take a look at return of premium riders. Yes, they cost more upfront, but in 2026, getting every single dollar of your premiums back at the end of the term is a massive hedge against a total loss. Anyway, here is your checklist. Audit your current policy today. Does it align with your 2026 net worth? Do you have a conversion rider that lets you flip to a permanent policy without a medical exam? If you don't know the answer to those, you might be at risk. Honestly, the goal is to stop being the 99% statistic that makes insurance companies rich and start capturing that value for yourself. If you found this helpful, definitely check out my newsletter where I break down these spreadsheets in even more detail. Thanks for watching, and I'll see you in the next one.